Life insurance versus family income versus term versus whole versus joint life. Which one is better for dependents? When it comes to protecting the people who depend on you, life insurance is essential. Most people assume any policy will do, but the surprising truth is that different types of life insurance serve very different purposes. Understanding family income, term, whole, and joint life policies helps ensure your dependents are financially secure. Term life insurance provides coverage for a set period, often 10, 20, or 30 years. If you pass away during the term, your beneficiaries receive a lump sum. It's ideal for covering mortgages, debts, and children's education during critical years, offering cost-effective protection when your family needs it most. Whole life insurance offers lifelong coverage and builds a cash value over time. Premiums are higher, but it guarantees a payout whenever you die, not just within a term. This type is useful for long-term financial planning, leaving an inheritance, or covering final expenses. Joint life insurance covers two people under one policy, paying out on the first death. It's often cheaper than two separate policies, and is ideal for couples who want to secure a mortgage or provide financial stability for one another. Family income benefit insurance pays a regular monthly income to your dependents instead of a lump sum. This ensures ongoing financial support, helping with day-to-day expenses, childcare, and living costs, especially for families who rely on your salary. So, which is better for dependents? The best approach often combines term insurance for immediate protection, whole life for long-term security, and family income benefit for continuous support. Joint policies can also help manage costs for couples. Life insurance isn't just about money, it's about ensuring your loved ones are protected, financially stable, and able to maintain their quality of life, no matter what the future holds. Choosing the right mix provides true peace of mind.